I mean, if you just look at these two numbers, renting looks way cheaper, right? So you would think, oh, I'm saving $200,000 over 5 years by renting. But if you never look at the equity side of it, you're not getting the full picture.
I can tell you from just living in this home now for almost 9 years, it's a constant work. It's work. You're always trying to keep stuff from falling apart. It's inevitable.
Me as a renter cannot take a HELOC on that property.
Yeah, because you don't own it. You don't get any
Yeah,
type
that's
of
what I'm
mortgage
saying.
as a renter. Oh, you got to be
That's what
clear
I'm
on that
saying.
one. Yeah.
Okay.
You said
Yeah,
you
okay.
can take out a HELOC on an investment property. Was your question?
No, I said you can't take a HELOC on a rental.
You said investment property.
No, I said rental.
Investment.
Roll it back. We're recording this. Roll it back. You might think paying $3,000 for rent is a smart move when mortgage for the same house is $3,800. But what if I told you that that decision could be costing you $126,000 in the long run? And in this episode, Jason and I are going to be breaking down why waiting for the perfect time is actually costing you tens of thousands of dollars. Hi, I'm Peter, and this is Jason. We're the Clear Close, the mortgage experts that help you get clear to close on your next mortgage. And if you're at the gym or at the office in your weekly TPS meeting and you're watching this on your iPhone under the table, then go ahead and take a quick screenshot of this. It's going to give you the basic information you need to get out of this video, and you can come back to the video when you have more time. But before we get into this video, please give us a like and a sub, drop a comment. Anything you do to engage with the algorithm helps us a ton. It costs you nothing, and it really helps this channel out a lot. Also, feel free to share this video with somebody who you think could use it. All right, back to the video. Jason, we've been talking about buying versus renting a lot. That's been kind of a conversation that's been going around, at least for the people that I've been talking to. Renting is still cheaper than buying. And we even did like a skit video a couple weeks ago where I was, the pre-approved buyer, and I was telling you I'm just gonna rent, right? And holding out on buying.
Yep. It's a common thing in our business because that's the the age-old question. Do we rent or do we buy? And
Right.
that sometimes you might be in a market where, the mortgage payment is lower than the rent. It's a very easy decision. But yeah, no, it's very common. It's obvious right now when rates are so high and have been persistently high the last couple of years.
Yes, the dollar to dollar, month to month dollar figures, yeah, it can be a lot different, right? Renting can be way cheaper, maybe even like $1,000, $800 cheaper compared to a mortgage, a month to month, and that's a big deal because cash flow is very, very important, right? My CEO, one thing he told me that I remember for the rest of my life is cash flow is the blood of a business. If you have no cash flow, then you die, right? So it's extremely important that people are thinking about this. But there's something that most people aren't really thinking about, which I think is a good time for us to cover in this episode, which is the actual opportunity cost, right? If you want to call it that, of not owning a property.
We're not CPAs or any accountants or financial advisors. So take this information, really think about it, and make sure you consult with the professional when it comes to that. But generally speaking, it's home ownership has lots of benefits, especially in California or high tax states with the new changes like the SALT cap increase, right? Property taxes. It's going to help you minimize potentially your tax liability, granted if you earn enough income. And there's lots of benefits to home ownership beyond just standard deductions. And
there's like some people on Instagram and TikTok, they're talking about the next wave of property investment is building out ADUs in the backyard. I mean, if you don't own your property, you can't, there's no opportunity to do that, right? So that's kind of like a loss of opportunity as well. If you're renting, like it is what it is. You don't really get to make any upgrades. If you do make upgrades without the consent of the owner, then that's just like money out of your pocket, and you might have to pay a fee or fine
you will.
Right?
You have to
like
be,
because it's not
your
authorized.
Your lease dictates like you rent my home and you use it as it is, and I expect it to be returned in that condition. So so if you change it, you have to return it back to what your moving condition was, minus any wear and tear items. So like you can't change the, if you change my paint color from white walls to green, I'm gonna have to, if as a landlord, if you move on and leave it green, I'm gonna take it from your security deposit and repaint my wall white. So
Yeah. No, I mean, I saw this TikTok. I think it was scripted. I honestly think it was scripted, right? But it was entertaining. The landlord was talking to her tenant, and the tenant was like, "Hey, I want a refund for the paint that I used to repaint your cabinets." And she's like, "What? What are you talking about? I didn't authorize you to paint my cabinets." And she's like, "Yeah, your cabinets were chipping, and they're all they're getting old. So I did you a favor, but now I want a refund for the paint and the labor." And she's like, no, you're not, right?"
you know, that's that's the thing. Like rent is easy, especially if you have a good landlord or property that you're in, or just a regular apartment. Because like if something breaks, like toilet stops working, water, I don't know, dishwasher, you just call your landlord. It's not your responsibility, right? So like it's like the headaches of just day-to-day living are simpler with renting. But man, rent's not cheap in California. Like
Yeah, I mean, on
even in
paper, the landlord needs to come out or send somebody, but you and I both know that that's not how the world actually works. There's a lot of landlords who delay, or they don't pick up their phone, or like they're lazy, right? And they don't send out a maintenance person. Like they're maybe strapped for money, right? And they just like,
Mhm.
hey, that's not my problem. Look at the contract. You got to fix it. Stuff like that. There's a risk in renting as well.
Yeah, because you don't know. Like, what if they sell the house next week, right? Like, sorry, you're gone. Like, here's your notice. We're gonna sell it within. You have to move out within 30 to 60 days. It's
Yeah.
That's not a peace of mind position to be in either. So,
Let's now move on to the like, what is the compound effect of ownership? What does that look like? Maybe we could do a little bit of like post-production b-roll and show people in the numbers. But yeah, I created kind of like a 5-year example. Let's start with the baseline of a home that's worth $750,000, and let's assume, okay, disclaimer: this is not your mortgage rate. This is an assumption of a 30-year fixed mortgage rate of 6.7%. So we're just gonna assume that. We're gonna down pay 20% in this scenario, which is 150,000. So the loan amount is 600,000 at a 6.7% fixed rate. Again, this is not yours, this is made up. Monthly P&I payment is going to be roughly $3,872 a month. And let's just say appreciation rate, be conservative, is 3% a year. Then
very
going by
conservative,
very conservative,
3%.
right? Yeah. So in this scenario, we're just going to break it down. Year zero, your equity is 150 because you paid down 150. Year one, you're paying down most of it's interest, but you're building up a little bit of equity. So you gain about $33,000 in equity for paying a whole year's worth of mortgage payments. So your new equity is 183,000. However, your home value appreciated. So instead of 750, you're at 772, 500. Okay, year two, your home's going to appreciate a little bit more, and you're going to gain a little bit more equity this time. So now your home value is at 795, 675, and your
Mhm.
equity is at 217, 375. The next year, your home's going to appreciate a little bit more, and your equity is going to come out a little bit more. So we're at roughly 820K for home value, and equity we're looking at around about 250. And then in year four, home value is going to go up again, 845, 844-ish. Equity is going to be about 290. And year five, home value is going to be around 870, whereas your equity total is going to be 300, let's say 29,000. In this scenario, after 5 years, you put 150K down, and you've paid monthly mortgage payments. And if you just look at cash flow, you're out $382,000, right? Like that's how much cash has left your bank account over 5 years. But you've gained something in the process. You've gained equity, and that is 320, let's say $329,000 in equity. So if you subtract the two, your equity gain minus your cash out, you're looking at a delta of $53,000. So consider $53,000 is the total cost, right? To purchase this home over 5 years. Now let's compare that with an example of renting a home for substantially less money. So let's say $3,000 a month in more rental payments. If you're paying rent over 5 years, then you're paying out of your bank account $180,000. So how much equity do you gain in a renting scenario, Jason?
Zero. And I feel
Zero.
like you're being generous too with the 180,000 or 3 grand a month in rent, because I can promise you your rent's going to go up because every year we raise rent every year, because cost to keep you as a tenant in that building costs me more money. So if I'm if your rent is 3 grand a month today, there's a good chance it's going to go up 5% just because my HOA or insurance is going to go up for that home, and then I have to pass it on to you. It doesn't mean me as a landlord I'm getting more money because I raise the rent. It costs me more to keep you in that house.
I think that's the picture that most people aren't really considering when they're doing their determination whether they should rent or they should buy.
Yeah, and then also simple way that I see it is if you choose to buy at like the $750,000 example, that's a starter home in California. That's a very darn nice home in Texas or Colorado. But for us, as a starter home, townhome, condo type of property here, and that appreciation, what you're missing out is what your plan is for the next 5 7 years, because that's the segue for you to go from that $150,000 down payment to a $300,000 down payment 5 years later to your next home,
Yeah, because you've
to
built up that
the million
300. Yeah.
dollar property, right? And
Hmm.
then same concept again. You're going to end up rebuilding that equity and appreciation over time. And then you're going to end up taking that original $150,000 you spent and worked hard to save up, and you're going to double that, triple that, and that's going to segue you into your forever home, right? It's a
Yeah.
long, so you just paint, like I said earlier, Peter, we're playing the long game, right? It's 20, 30, 40 years down the road. It's like if you're
Yeah.
looking to justify anything in the next 5 years or less, 3 years especially, or next year, it doesn't work that way, right? It's a major commitment to your family's future and your future wealth for yourself, right? And the opportunity you create with a stable place that you can call home. It's yours, right?
Right. And this calculation doesn't take into consideration how much tax write-off you can make, right, with the SALT deductions or uh when you own, I mean, when you're paying mortgage, you have the options of taking out equity to do like a HELOC, right? Um, you can't do a HELOC on a rental.
Yeah, as a tenant, you don't own shit. So yeah, you can't do it.
I'm gonna keep that in. uh, if you are a renter, you can't take out equity from the property that you're staying in because obviously you don't have any equity in that property. So a HELOC is out of the option. HE loan is out of the option. The landlord can take out equity from that property. And unfortunately, if the landlord folk, they screw up and they foreclose
Or
or
not
they
even for
default.
scare up. It's if they like, I don't like this house anymore. I'm gonna sell it to somebody else because you know what? You've paid enough of my rent for me the last 10 years that I'm gonna 1031 exchange into this complex down the street because you've given me $500,000 in equity in the last 10 years.
Yeah.
It's pretty nuts if you think about it.
I mean, at a certain point, it is actually way cheaper, right? Like, I think we were talking about Irvine, right? It was like $8,000 for monthly mortgage versus $4,000 for rent.
Yeah, but
Like
then
in
you
that
also have to
case,
remember that person
yeah,
bought that house for 300 grand like 30 years ago.
yeah. But in certain, I mean, there's a tipping point where it actually does not make sense to buy versus rent, right?
Mhm.
Yeah, but you have to do the math. That's basically our point here is you have to look at the big picture and see what the opportunity cost is when you're making your decisions. And if you're not in a position to afford the extra 500, 800, $1,000 a month for a purchase, then again, what we're going to say on this channel, we're going to be consistent on it, is just don't buy the house if you're not comfortable making those monthly payments.
Yeah, just work harder and budget and save more, because if you're comfortable with the $3,000 payment and you want a $1.5 million house, you just got to put $1 million down and you'll get the payment you want.
$1 down. You're gonna you're gonna hear something from the comment section about that.
But then it's not impossible to have $1 million down if you had a starter home and you built wealth and you worked on it over time. Because like I said, there's another example of a friend who started with a tiny condo townhome in Anaheim, and and then took that time frame of 10 years and now are in a home that's 7 figures in Fullerton, right? But it all started with 3.5% down with FHA loan, and all of the equity appreciation that was built up from the home, each of those homes increasing in value, and
Yeah.
every mortgage payment you've made from then, even as small as that principal payment is, that's you putting it into your future home equity, and
Mhm.
that builds up over time. And there's
Yeah.
definitely little hacks, in my opinion, where you can build that little equity faster and cut off years of your mortgage for just a few $100. That's a different story. But again, you have to start somewhere. And if you're okay with, in my opinion, renting and burning 100% of your money, by all means, if your math makes sense. But the purpose of today's video is more of, did you think about the missed opportunity of owning a home sooner rather than later? Because again, home ownership is not for everybody. Some people are just made to rent. There's nothing wrong with that either. But if you have any desire to, in my opinion, build wealth over time and have a place that you can know is safe for you and your family, home ownership is important, and you have to start somewhere.
Nothing worthwhile doing is easy. That's what I always
Hmm.
tell my kids. Nothing worthwhile doing is easy.
Exactly, because
Yeah.
it's a sacrifice for today, which means there's something you'll get from it in the future.
And Jason, if people want to learn more about these hacks, how to get from one home to the next home and leverage their money in a smart way, what can they do?
Click the link, subscribe, call us, set up an appointment. Let's figure out like a long-term plan. It's no obligation. I'm going to tell you, yes, you're ready or not. And if you're in Southern California, like particularly Orange County or LA, we can help you from real estate to financing. So,
All right. So thank you guys for watching the video all the way to the end. We really appreciate it. And like Jason said, if you want help with any of the topics that we covered here on this video or in the channel, click the link below to schedule a one-on-one consultation. It's free. There's no pressure. And remember, we are the Clear Close, the mortgage experts that help you get clear to close on your next mortgage. All right. Thanks so much. And we'll see you guys on the next one. Bye-bye.